Today, I'm going to give you a tip that can save you tens of thousands of dollars, if not more than that. But you're going to have to wait till the end of this video to get that tip. So at 360 Wealth, we provide financial planning, not financial advice. So financial planning is very proactive, making sure that you're looking after your clients' needs, regularly meeting with them, and addressing their concerns before they even know that it's a concern. Financial advice, on the other hand, is very reactive, just addressing the client's questions as they come up and typically not getting to know your client very well. So at 360 Wealth, we provide holistic financial planning. So if you're interested in learning more, check us out at 360wealth.ca. And if you're interested in learning whether you're getting advice or if you're getting true financial planning, we encourage you to download our free 20-point checklist by visiting 360wealth.ca/planning. All right, now for our tax tip. So if you have multiple properties, like many people do, they've got a principal residence, they've got a family cabin, or even a rental property. We encourage you to make sure that you're tracking all the expenses associated with those properties, all the capital improvements. So, for example, the purchase price of the property, any legal fees, any fees associated with replacing windows, a roof, a deck, any renovations, etc. And the reason why that's very important to make sure that you do on all of your properties, including your principal residence, is because down the road, you're going to either sell that property or you're going to pass away and the property is going to be deemed disposed of. And when that happens, you're going to have to figure out how much tax are you going to owe. Now, a lot of people will say, well, it's my principal residence, so therefore I don't owe tax on that. And that is partly true, but just remember that you can claim your principal residence and as your principal residence and not pay tax on that. But you can also claim a family cabin if you use that cabin throughout the year and it's not rented out. Right. And so your home may not actually be the residence that you claim as your principal residence. So you can claim your family cabin, you can claim your home, whichever works best. So therefore, in order to figure out which is going to be the best to claim, you're going to want to make sure that you have those costs all tracked. Now, what happens if you don't? Because we do see it all the time where people don't have these costs tracked. And let's say that you end up selling your family cabin, you bought it for $650,000, you put let's say $100,000 into it. So your overall cost base is $750,000, but you didn't track it. What'll happen is when you go to sell that, you will claim that your cost base is $650,000. And let's just say that it's worth $950,000. Well, you suddenly have a $300,000 capital gain on that property. So you're effectively paying tax twice on that $100,000. Once when you earned it, and then once again when you sold the property, and now you have to pay capital gains tax on that. So keep track of all your properties. Do it in a way that is going to be beneficial for whoever's coming after you. So if you pass away, someone else is going to be able to find that information and be able to decipher it. Keep receipts as well. Super important. Something that we discuss with all of our families. I hope you found this helpful. Thanks. Take care.